Welcome, everybody. Thank you for being with us today, and thank you for joining us this afternoon Eastern Time. I will tell you that I am not where I normally am, usually in Park City or New York City. You guys are in San Francisco, right?
Yeah, correct.
Yeah, so our guests are in San Francisco. Thank you, everybody, for being with us today. We are having a Family Office Insights Luminary series, and we encourage you to post your questions to the chat box or the Q&A. We'll get to as many as possible. We have a lot of people joining us today, and super excited about having Romain. And is it Romain or Roman? Is it lettuce or what is it?
It's super hard to pronounce, I've been living in the US for like now 15 years. A lot of people say Omar, so it's even not Romain or Romain. It's Romain, but you can say Romain like the letters. It's fine.
Yeah.
Yeah.
So I've just, not to take up any time, but I've been spending the last 3 weeks in Egypt and Greece, and my language skills are shit. Turns out. So if I pronounce it wrong, forgive me. But Ben, I got you. So thank you again, everybody, for being here, and thank you guys for joining me today. Please feel we're going to record this and post it to the Family Office Insights YouTube channel. But more importantly, if there are folks that you know of that after hearing this that you think would enjoy learning more, we're going to make sure you're in direct contact with Oman and Ben, and so you can talk to them directly. And also we'll be having another pitch webinar. This is more of an interview fireside chat, so we can get acquainted and see what's going on with the fund and the industry. But in a week or so, we'll be doing another pitch webinar, so you can welcome your friends and colleagues onto that as well. So we'll keep you posted. So with that, thank you all for being here. Thank you guys for being here. Oman, take it away.
First of all, thank you, Arthur, for having us today. So some words I understand on my background. I was born and raised in Paris, France. So I'm French, not a US citizen yet. I'm French, and I've been living in the US for 15 years now. Sometime long time ago in New York City, but mostly in the Bay Area. And I've had like two sorts of careers. It's like part one and part two up to now in my life. Part one was I was actually a diplomat for 14 years. I was dealing mostly with war and peace, mostly in Africa. I was, for a couple of years, the advisor of the French president. It was super interesting, dealing of businesses, of course, but also of war, peace, counterterrorism, this kind of stuff. And then I changed 180 degrees of career because I joined 8 years ago, the French Sovereign Fund. I fell in love with tech, I fell in love with entrepreneurs. So total shift in career. And then I joined a large financial institution, doing a lot of things, providing debt to companies, investing directly as a VC fund, as a private equity fund, doing fund of funds. So was investing in VC firms everywhere in the US, Europe, Asia. And now we'll talk about that, of course. Joined Ben, he will introduce himself in a second, to build 212 Angels, our unique VC firm.
Great. Maybe so background, I'm originally French, I'm also American now. if I go back to all my studies, so I studied engineering. I have a master's of science in engineering way back when in France, and started to actually not really use it too much because I transitioned pretty quickly to banking, which is when I came to the US first. My career has always been effectively at the mix of strategy and finance. I went to Wharton. I have a CFA. I've worked as a consultant for Boston Consulting Group, as a banker for Barclays Capital, and for the last 9 years, I've been working directly in tech at LinkedIn as head of M&A and strategy. So, which also includes investments, which we'll probably talk about later on as well. So that's the background, mix of strategy and finance. Love spending time with entrepreneurs, which ultimately led down the path of becoming a venture capitalist.
So I think it might be helpful, even though Aman mentioned it briefly, how did you guys converge to throw in together?
My God, a lot of things. First of all, we are two passionate guys. So we met like almost 10 years ago on a Sunday night, San Francisco, playing cards at a friend's place. And we discovered back then that we shared at least two passions. Passion one, playing guitar. So I used to be in a band. Now it's over. Ben joined the band recently. He's on stage now, and he's much better than me, so that's good. And the second passion was, and still, investing, tech investing, and in particular, the passion is, or the question that we had and we still have is how to use data, how to use technology to invest in tech and to be a better investor. So we've been talking a lot about this topic over the last 8-9 years now. And that's probably the reason, one of the reasons why we converged. And we will talk a lot about this during this chat. I think the other reason is that we are both immigrants, right? We just talked about our background. And, you know, I'm sure in the audience, we have quite a lot of immigrants because this is America. And when you're an immigrant, you know, you have sort of a chip on the shoulder. You want to do stuff. And because Ben and I, we come from the corporate world, we really wanted, so as immigrants from the corporate world, I guess both of us wanted to build something, to become entrepreneurs. Because when you, as we do, when you launch a VC firm, you're a VC, but you're actually an entrepreneur. It's the same thing. You raise funds, you build a product, etc. It's the same thing. So we both wanted to build something, and I guess we both wanted to prove that's the immigrant part of us. You know, we wanted to prove that we can do stuff and hopefully better than anyone else. That's the chip on the shoulder. I think that's why we converge, Ben and I. But if Ben wants to add something, or if I'm totally wrong, I will let him speak. But I think he will agree with me.
Oh yeah, on the background and the reasons, totally. I think we're also a very good match. I was sort of reflecting on this the last few days, but we are both a little sort of passionate, as Romain said, and a little bit obsessed, but with things that tend to be complementary. So I tend to want to move fast in some ways and sort of push the envelope every time. And Romain brings in a lot of discipline in terms of actually let's do things, but let's also process things. And so we'll maybe talk at some point, but we've automated pretty much everything we do, and that's entirely Romain's vision. And I think from that standpoint, we're very aligned on the vision of what we want to build, and have sort of very complementary skills and sort of even networks to start with to actually get that done.
Yeah. I have a lot of questions, but if you don't mind, I'm going to sort of throw out a couple controversial things and make statements that I can't support. So
Okay.
There's
Those are the best.
yeah, the I think in general people would, even if it's just what they've heard, would think that the VC business needs a retooling. And one of the basic reasons for that is that the Silicon Valley, mafia or whatever you want to call them, I'm at liberty to say whatever I want because no one has a gun to my head. They've got a corner on, great deal flow and arguably make it great even if it's not. And then the spray and pray thing and give entrepreneurs lots of money even when they don't need it because they want to flush 90% of it, so 10% is the unicorn. And that seems to be the consensus. And like I said, I can't support all that, but that a lot of people have that viewpoint. And there's been a lot of talk also with VCs trying to use AI and data and that sort of thing. You're doing some super cool stuff that I haven't quite figured out how you're doing it. So we'll get to that in a minute. But how would you distill your methodology and your embarking on this VC fund that's different than what we've come to expect from VCs? I know that's a really broad question, but that may be a good place to start.
Great question.
Great question, and actually, maybe to your surprise, I think we'll agree with you. Now, to answer your point, first of all, because of our background, we are both, Ben and I, we're both close enough to the VC industry, not only because of course, we live in the Bay Area, as you said, Silicon Valley, but that was also our job. So we're close enough to the VC industry to have some insights and a deep understanding of how it works with its strengths and flaws, but deep understanding of the VC industry itself. At the same time, because we were not VCs, we had some distance within the industry. So actually, I strongly believe that we have this kind of great position to be an observer and an actor at the same time. And the most important thing is that because it's our first firm, we don't have any legacies. And it's easier when you don't have any legacy or 10 years of culture, or there's nothing behind us. So we can build something from scratch. This is when you can innovate. So that's the first thing. This second thing, and I think you may love it, Arthur, is the fact that there's a sort of a VC paradox. And we've been puzzled by this VC paradox, if I can say so, which is this industry is an industry whose goal, whose mission is to finance technology, is to create or help create innovation. At the same time, VC industry doesn't use the very technology that they finance. It's like, think of a dentist who has no toothbrush at home. It doesn't mean that you don't have any great VCs. You have tons of great VCs, and we're actually working with them. So it doesn't mean that VCs suck. Actually, it's not the case at all. It just means that there is a room, and actually a lot of room, for disruption in the VC industry. And I'm sure you and your audience, you've seen that for years in many industries. When you don't have any technology, any software in an industry, it doesn't mean that people working in that industry don't do their work well. They do. It just means that there is room for disruption and
or just simply improvement
and better performance,
right?
Or simply improvement. Absolutely. Yeah. So that's what we do.
So a little color, I think, might be helpful in that both of you have had interesting perches to be the observer. Mm-hmm. LinkedIn, for example, which is just chock full of
yes,
people toiling away to be entrepreneurs or get a good job or whatever it happens to be, and then actively involved in the venture part of LinkedIn. So you've been participating in it in some way, and then, some just shy of $40 billion sovereign wealth fund, right? On the French side, and being in corporate America as an interesting perch, right? Because you see things that you wouldn't otherwise see. So I think the audience would appreciate having I gave them the color. We don't need to spend any more time on that, but I think that's really interesting that you've been able to, have institutional quality viewpoints.
Maybe two stories
Sure, of course.
that come from there is the first one. Romain said, data and venture and technology has been one of our hot topics for many, many years. One of the places it crystallized the most is while at LinkedIn, I had the chance to work quite often with Reid Hoffman, who both he's a great VC, but also the co-founder of LinkedIn. And so we actually spent time, he and I, with data scientists at LinkedIn to analyze LinkedIn data to predict future startup success. And again, like in the context that this is one of our sort of hot topics with Romain, and it was very interesting because what you learn is from that analysis that we did is there is operating signals, and some of them are on LinkedIn that you can see after a Series B. So everybody will think about growth, but actually the real signal from a headcount perspective is the ratio of hires to departures. So even if you've grown 8 people, it's actually a much better signal to have hired 8 people and lost 0 versus hired 12 and lost 4 in terms of chances of future success, becoming unicorn, etc. Who you hire from and who you lose talent to is also super important. So LinkedIn has this, for example, internal ranking of companies based on who do they win and lose talent to. And for many years, Snowflake, before the IPO, was actually at the very top of that list. But that is a little bit to your question. It's a little bit of one of those exceptional things you can do while you're at LinkedIn that also bring us back to why we use data, and we can describe in more detail what we do, but we use data to screen and source, to source and screen the entire environment, and that is one of those things that we spend time on as being sort of close to the system, but a little bit sort of doing different sort of experiences than the average VC. So that's one, and then the second one is maybe we've spent a lot of time because of that talking to data science teams outside of LinkedIn. But for example, AngelList sees about 1/3 of all deals in the US, all deal flow. And we know Abe, the head of data science, we had a bunch of discussions with him, and a few things come from those discussions that we've incorporated into our strategy. The first one being at seed, so the very early stages, you actually need to do a lot of volume of credible deals, but the way to maximize returns is actually a lot of volume and not concentration. And maybe something for everyone to think about as you're considering managers is one of the best signals of future success and repeatability of success is actually what's called the graduation rate. And so if you're a seed investor, the way to evaluate if you're a good seed investor is how many of those seed investments that you've done converted to become a Series A within 18 months. And it's a little bit like the Moneyball approach, and it's applied to venture, but it's basically saying, if you want to score points at baseball, the number one metric that turns out matters is, do you go to first base? And here it's the same thing. You're a seed investor. Ultimately, you want to score unicorns and big exits, but the first step that really matters is, do your companies go to Series A?
And an interesting data is, so what's the average in the market? And the average in the market is 16-17%, which means on average, seed firms or the companies at the seed stage in all seed funds, on average, 17% of them raise a Series A in less than 18 months. That's the average. So if you look at a firm investing at seed and their graduation rate in less than 18 months is, for example, 20 or 25%, quite a good performing seed fund. If it's 5%, not so good. This is how an example of how you can use data to look at investment in a company, in a fund. Using data in tech investing is super important. That's our thesis.
And by the way, we use this exact same data to choose who we work with and co-invest with as VCs.
So can I challenge a couple things? One is everything you said makes sense. And then all of a sudden, it's not cool to be working at Facebook. And so your data point for people that left the round A company and left for Facebook prior to that was a bad sign. Now it's, or a good sign, or vice versa, right? So that sounds like a manual data point tweak that you'd have to make to assess that if you're losing people to Google or Facebook, and then all of a sudden losing them is a bad thing, not a good thing, or vice versa. So how much of that is like human intervention to say, okay, at what point does losing somebody to a firm that is a red flag turn?
To be clear, this is not what we do because we invest before Series B, but that's one of the signals found on LinkedIn.
Gotcha.
Effectively, that ranking is actualized every month, so you can take those things into account. But maybe to give you a little bit inside baseball, while Facebook isn't all cool and just laid off 13% of their workforce, their net employees is still up by more than 30% year on year. So they're still a very attractive company. Sure, they've got bad press, even more so recently, a lot of it for very good reasons, but they're still a hiring machine.
Yeah. All right. So not data in a vacuum, right?
Yes, agreed.
Because,
Oh, totally. Yeah. You can't have data that is stuck in something that was happening 5 years ago and say, oh, that's the truth for it. It is dynamic for sure.
Yeah. So can I jump into something that just completely blew my mind that I read about you guys? And maybe I read it wrong, but maybe not, is that one would argue that your network as an entrepreneur and a founder is super valuable, and that allows you to get capital, resources, connections, business development, that sort of thing. And did you discover something in a way that allows you to find those founders that don't have that robust network, and they can't find you, but you can find them? Did I get that all wrong?
Yeah, absolutely, totally. Maybe we can come back to answer your point, but have a broader view. Maybe we can talk a little bit about how VCs work, usually what you need, and then it's going to be an explanation of what we do, and then come back to your point. Sorry for that, but well, I'm sure you all know that. But the way VCs work, since a long time ago, you need three ingredients in the VC recipe. You need the network. We talk about that, but you also need time, and of course, you need some capital to deploy. But the two most important ingredients in the recipe, it works both for VCs and on the other side of the table for the funders, as you mentioned. It's network and time. And then you have lots of problems. Problem number one, back to your point, there is a high chance that your network becomes pretty quickly irrelevant with time. For example, so you're an investor and you used to work at Google or Meta, and you leave the company, you build your VC firm, and that's just right. You have a strong network at Google, or Airbnb or whatever. So usually, you know, when those people leave those companies and launch their own companies, there's some chances that, you know, it could be a hit, a unicorn. Tons of unicorns have been funded by former guys from Airbnb, Google, et cetera, et cetera, et cetera. The problem is, 5 years from now, how many people do you still know at Google? In other words, the Googlers who will leave the company in 5 years and build their own company, do you know them today? Not sure. Another example of the network problem. You used to work in a blockchain company or in the crypto space. So now you become an investor and you invest in the crypto space or NFTs. Fine. It was super hot up until today. 5 years from now, are you sure that the NFT space, for example, or even the crypto space in 5 years will still be hot and relevant? Maybe yes, but maybe not. So you have like each network from a VC perspective has a risk to become irrelevant 3, 5, or 10 years. The problem is that, you know, VC firm, it's not for one, it's just, you know, it's a long-term cycle and a long-term game. So that's the problem number one, which means, to your point, if you're a founder somewhere, because VCs need networks to source their deals, if you're an entrepreneur and you don't have any, you know, connection to the investor, you probably won't find any funding. But you have, you know, the second big problem is time. Investors, you need, you know, some time to do your work. You need time to review the deals, to source the deals, to win the deals, to close the deals. But also you need to manage your firm. You need to think of your communication, your brand, investor relations with your LPs, et cetera, et cetera. So on a daily basis, you don't have so much time to source and review deals. And you know well, because with your group, you spend a lot of time reviewing great deals, right? So, but your time is limited. And the thing is that over the last 10 years, as you all know, you have more and more entrepreneurs in the market. And 5, 10 years ago, most of them were in the Bay Area, and then a little bit in New York City, and that's it. And today it's not true anymore. You have great deals, great entrepreneurs in Utah, in Florida, in Chicago, in Seattle, in Austin, Texas, in Dallas, everywhere, but also in London, in Paris, in Berlin, in Israel, and in Brazil, everywhere. So not only your network, again, is limited, so you probably will miss the new entrepreneurs where they are today. It was not the case, you know, 5 years ago, but also you don't have time anymore to review all those deals everywhere because tech has exploded and it will continue in the future. Which means you just have time to review a tiny, tiny, tiny portion of the market. That's the problem with the VCs. And that's the two problems that we solve with technology. And now we can talk about what we do, but at least you have the context of the problems we are trying to solve. Also, one last point. At Seed, the best way to maximize your returns is not to have a small concentrated portfolio, like 10 or 15 bets. At Seed, the data show that to maximize your returns, you need actually a large portfolio, a lot of deals, credible deals. Credible means with the potential to become huge. That's what it means. So it's not spray and pray, because spray and pray, you don't know if they are credible, you just pray. But if you can vet a minimum, you know, just be sure that, yes, that's huge potential because the team is great and they are working on a great market, so it's credible. Will it become a unicorn? Honestly, at seed stage, you don't know, but at least it's a great deal. And if you have a large portfolio, then that's what the data show, then you will have the best performance. And with the problem that I just mentioned, network and limited time, that's the reason why all VCs end up with a concentrated portfolio, because they have no time. They have no time to review everything and to invest in everything that is credible. So they have a small concentrated portfolio. You need a large portfolio at seed to maximize your returns. This is what we do. And we do that with technology.
Yeah.
So without revealing the secret sauce, unless you want to, how are you getting the companies to review the data that will then allow you to deploy it into many of those companies?
Yep.
You have to. No, Ben, go ahead.
Sure. So you understand the problem, volume to start with. We, at this point, review 5,000 companies a year without doing anything, all algorithmically. So we source, and the sourcing is fairly easy, and we think it's a commodity at this point, but you can find a lot of information online about companies that are in, we invest only in B2B North America, and that's where we find 5,000 plus companies a year. Databases, all the accelerators, and of course, because we work with all the top VCs, they share deals with us, etc. But the difference is we don't need an army of associates and analysts to do the job of screening. Our algorithm does that. The algorithm looks at three things: your education, your professional background, and inferred personality from what you write and say publicly. And so in many ways, we don't have to know those founders. We don't have to ask them to fill in a questionnaire or send us an email, anything. We find those founders anywhere, find the information on LinkedIn and other social media that we need about them, put it into our algo, and the algo is trained on this question, which is, will these founders, the day of inception, raise at least $20 million? Basically, do they have better chances than usual to raise $20 million or more? Call it a Series B. Which goes to this point that I made earlier, the graduation rate is how you are, a high graduation rate is how you are successful at seed, and that is entirely what our algo is trained on. By looking at the people, are those the right founders to start something that has good chances of success? That's the first element, and that's the first barrier, if you will, in us saying, okay, we've seen those 1,000 companies, how many have a credible management team? The second thing we do, which is where we have our specialty, is B2B, given the purview I've had over the years at LinkedIn. We do diligence. We understand that they are in a place that is big enough, that they're solving a real problem in a market that is big enough to build a big company. And then the third criteria, which we've alluded to, is we want what we call a credible deal, which is a deal that is led by a top VC, and we evaluate that from a mix of brand, but more data actually, and their graduation rates themselves. And so that's how we're able to go fast with the founders, which is our promise, and write a lot of smaller checks in a lot of credible deals, which ultimately leads to, we're already seeing it, very high graduation rate and in time returns.
So what's the attribution for, or how do you do the attribution? Maybe that's not the right word. So how have you been able to demonstrate that your thesis works so far?
First of all, so we launched January 2021, 22 months ago. We made, just last year, 28 seed investments, 28. Out of those 28 investments that were made between January and December 2021, 9 of them, 32%, 9 of them have already raised Series A. So, and the last one, so made in December of that year, December 2021, it was 11 months ago, not 18, 11 months ago. So remember the metric that to us is a key metric to evaluate potential of a seed fund. We are already at 32% graduation rate from seed to Series A in less than 18 months, 32%. There is better than us in the market, SV Angels, for example, which is in terms of performance, number one seed fund in the US. But we're number 6, actually, to your point. Based on, again, this metric of performance, graduation rate from seed to A in less than 18 months, we're number 6 in the US out of, I don't know how many hundreds and thousands of seed funds. So that's to your point, the first element that shows that, yeah, it's working. The second element is that we are working only with top investors. In our model, what we want when we invest in a company is a top founding team, and the deal has to be led by a top investor. Andreessen Horowitz, I'm sure you know them, Sequoia Capital, NFX, First Round Capital, all the top seed firms and multi-stage firms. All our deals are led by one of those firms. And today, we now know that what those top firms not only love what we do because they share deals with us, because they co-invest with us in our companies, but more than that, some of them are now investing in our firm. Funds like Emergence Capital, NFX, Foundation Capital, those guys, they made, Netflix, Uber, and many, 32 IPOs. They are now investing in our fund too, and others, AVC and others. So those guys not only work closely with us more and more, but some of them even invest in us. So to your point, it also shows that, hey, maybe we're on something great. That's the second, for us, element.
So
that shows that it's working.
Yep, perfect. Oftentimes the challenge for VCs is the follow-on rounds. And maybe in your model it's not, because you pick them so well that the seed amount that you put in is going to be more than enough. But it's often said that I wish I could have had, the next round a better allocation, and I would have, been able to grab more cash, right?
Totally.
How are you handling that?
You're absolutely right. And I know that for you and your group investors, access to, those follow-on deals, rounds, access is absolutely key to what you do. The thing that we mentioned is this: in our model, not only we have this algorithm to source thousands of co-founders and help us, cut through the noise, so we can focus our resources and our time only on those top funders. Second element of the model I just mentioned is only co-invest with top investors only. So our portfolio is just a Christmas tree of logos, actually. The third point is the services. When we invest in a company at seed, we provide the company with value-add services that we pay for. And those are outsourced services. For example, when we invest in a company, we provide an executive coach to the CEO of the company. We pay for a sales training program. We invest in B2B companies. So having such a sales training program makes total sense. We provide them with personal concierge. We provide them with a culture program, help them build and scale their culture. We are now testing new services, hiring, for instance, etc., etc. So for our check, which is pretty small, and with the high value of the services, result number one is we win all the deals that we want. So I'm talking here about the initial check, the first check. We target a great company, great funding team, great investor. Because of the services that we provide, we win the deals. By the way, the investors love what we do. Small check, so we bother no one, and high value. That's why they love us, and that's why they invest now in the company, in the firm. Now, follow-on rounds. Because of the services that we provide, the founders are super happy with us. So it's not really Ben and I. personally, it's mostly the services that we pay for. As a result, we always have allocations in the follow-on rounds. In our fund one that was closed 2 years ago, there was no reserve. So what we've done so far in all the Series A's that I mentioned, we had to make some SPVs with our current LPs, but we've had outsized allocations. To your point, example, a company called Draft, Orthlieb Ventures did the Series A. We invested, our initial check in this company was 100K, very small check, right? At the Series A, the team at Draft, the company, the funders, they gave us $1 million allocation. We were only able to fill 500K, unfortunately, but we had $1 million allocation. Again, the reason is just the CEO just loved us because we provided him with so many services. By the way, Ben is an expert in M&A. Right now is helping one of our portfolio companies that may be acquired by a public company. He's spending a lot of time helping the funder at a key moment of his life. So you also have to think about the psychology of funders. Selling a company is the big moment of his life. And the only guy that will help him, because it's very specific expertise, M&A, it's going to be Ben. So you can imagine that when this funder will probably launch another company some years from now, for sure he will call us again to invest in this company. But that's so we have outsized allocation in follow-on rounds. Another company, Bento, Series A last year, 100K check at the seed round, and we had $600,000 allocation for the SPV that we made for the Series A. So we think that we're able to have, despite small initial checks, to have between 500 and a couple of $1 million allocations in the Series A's that our portfolio companies will raise.
So it's super helpful. You had mentioned something in your notes about, and if there's something more interesting or more important you want to chat about than this, although I found it fascinating, is the intention was not to come out with both barrels screaming about diversity, but it turned out diversity wasn't. It just happened, right?
Exactly. It was not our intention. As you can see, we are two white guys.
Yeah.
We're French. Maybe that's diversity here, but that's it.
Close enough.
Yeah, but of course, we strongly believe diversity is so important to the success of companies for various reasons, but it was not the intention to have diverse outcome. So, but this is what happened, as you said. And the reason is the following. By the way, coming back to your previous questions on, if you're a funder, what's the role of your network? Funders need a strong network to fundraise, because again, that's how VCs work. So as a funder, if you don't have any network, good luck to raise, at least to reach out to an investor and raise money from the investor. The key problem or challenge for women funders, for minorities, Black funders, Latino funders, etc., is that on average, again, it's data that we have from LinkedIn, and Ben helped a lot gathering this data. On average, diverse funders have a network that is smaller than the typical white guys from Stanford. Not only smaller, but also of lesser quality. In other words, if you're a white guy and you've been to a very good US university college, you have a large network, and in that network you have a lot of entrepreneurs, angel investors, institutional investors, probably some family offices as well, etc. If you are a Black woman somewhere in Texas or Michigan, on average, your network is not as good. as the previous one. And as a result, you have more problems to raise funds, right? Because VCs need to find you. The way we work, now you understand, we don't need any network to find funders, even though we use our network to source deals as well. And we send those deals to the algo for scoring. But because we have boats and we have a machine that finds anyone anywhere and scores the quality of the team, so we don't need anyone in any connection with those funders. That's the reason why we were able to find top Black women, top women, or top Black guys anywhere. Example, Canaris. We invested in this company called Canaris back in June last year. An amazing Black woman, founder, CEO, who raised the Series A 6 months after her seed. And she is based in Dallas, Texas. We were able to find in Canada a Black team, company called Draft. I already mentioned it. The result is we have 42% of women founders in our current portfolio. Today, we have invested in 38 companies, 28 last year, 10 this year. So a total portfolio of 38 companies, 42% women co-founders for the reason I mentioned. We don't need networks to find funders. We have 21% of women CEOs and 8%, not enough, but it's 5x better than the market, 8% of Black co-founders. That's the outcome of a programmatic approach.
To put a finer point on the value of the network, if we use Mendy, who's the CEO of Canaries, who we've mentioned, her network is likely 12 times less valuable than a founder that's coming out of Stanford, white founder out of Stanford. Like literally, I got the data from LinkedIn. That's how much of a difference it is.
That's a big multiple.
It is a big multiple in terms of opportunities that you can have from your network.
Yeah. Wow.
Absolutely. So
the beauty, if you don't need the network with our approach, then in some ways you push through the network barrier.
Exactly.
So we talked about this, but can we just repeat it for somebody? And they said, maybe I missed this. Thank you, Daniel. What does the 2.12 algorithm use as inputs to find deals? They mentioned that they don't need a network to find founders more than once. Is their inputs solely LinkedIn?
Yeah, three inputs. One is the education of first. It's usually on LinkedIn. Education, number one. Number two, professional background. What you've done in your past, working in startups, in corporates, both entrepreneur, not entrepreneur, this kind of stuff. Professional background, also usually on LinkedIn. Input number three, your personality. And we don't send questionnaires to founders. Some other firms do that, good, but you have a selection bias problem. We could talk about that, but we don't do that. If you're a founder and you wrote blog posts, you made an interview that is on YouTube, for example, or you just wrote articles on your website, on social media, etc. Our machine will capture that. It's going to go to a personality engine, which are now super performant, and it will come back with your personality traits. So those are the three inputs that we use. And then the algo was trained on the following question: what are the chances of this team with such an education, professional background, and personality? What are those chances to raise a Series B? Then we have a score, and based on the score, we decide to reach out to the team or not. And if we decide to reach out to the team because the score is high, then that's the process. We have 2 Zoom meetings. Zoom 1, we talk about the product, we talk about the market, is it big enough, etc. Zoom 2, we check stuff with the team. What is the team dynamics? What is the psychology of people? They're great. That's what the algo said. We just want to make sure they're really great. And then we give them our answer the next day after the second Zoom, the next day at 12 p.m. sharp, hence our name 212. To Zoom meeting, the answer the next day at 12 p.m.
I was wondering when we were going to get around to what the name was all about, because I imagine, as I did, I thought you guys were from New York, but
Nope, it's a process.
Yeah, to the a little more precise, if you don't mind, the LinkedIn is not the only place. It's just going out to the ether and the
Yes.
Google searches and the screen scraping and the so on and so on and so on. TechCrunch,
That's right.
PitchBook. You just go down the list, right?
Yeah.
Yeah. Super
And it
interesting.
doesn't need to have any specific thing. We don't have any particular deal or backdoor access or anything to LinkedIn. It's just it's basically what's on the page we can use.
Yeah.
So let's give you maybe some example to just give some color on because this could sound like a theory. I know we don't have a lot of time, but let's take, for example, Christina. We found Christina Key, CEO, co-founder of DataBento. At the time, she was based in Boston. Never lived in Boston, Ben either. She scored super high with this algo. Christina was a student at MIT 10 years ago. So when she was there, 20 years old, in her dorm room, she decided to build her own hedge fund. So she launched her own hedge fund from MIT at 20 years old. She worked there for 9 years. Then she discovered the problem. So she decided to leave the company to other people and build a second one, which is DataBento, that now provides financial data to any fintech companies. This is the kind of profile that we find. It's a woman, Christina, but building a hedge fund at the age of 20 while at MIT, that's what we can call a great founder. Another example, totally different profile, but to give you an example of what we can do with such an algo. Keep Financial, for example. Here's a team of Rob and Catherine. They founded 18 months ago Keep Financial. We invested last June in that company, around led by Andreessen Horowitz. But Rob and Catherine, they are 55 years old, something like that today. They've been working together, which means they've been funding companies together for 25 years. The previous one was Cabbage. Maybe some of you know this company, Cabbage, but they sold
Sure.
to Next for $1 billion. They have the same score as Christina. So you have a young girl from Boston, MIT hedge fund woman. We have, older people, but they sold their company for $1 billion. This is what the algo finds. We've done nothing, zero to find those people. So honestly, we strongly believe now that technology is a miracle. You can do miracles things with such an algorithm. I could go on and talk about all the 38 companies. Everyone's going to be bored.
No.
Some examples of the profiles that we find.
I don't think they would be bored, but we're going to run out of time. But I'd love for you to go on. Is it okay that if something doesn't fit into the qualify properly, is it okay that you missed it? Meaning,
yes,
all the other things are good, but, and I love saying this because I proved my parents wrong. So I'm a college dropout, and I've had wild, disastrous failures in my life, and I've come out of the end and had some wild successes. And so, I mean, I wouldn't fit into your algo, but it's okay if
not
you
sure.
missed it,
No.
right?
I wouldn't say so. We have some dropouts actually that scored very well in our algo. This company called Marmley. The reality is it's fine-grained enough that you will find profiles that are very different. So you will find a canonical Stanford science, computer science, and sort of 3 years out of college working for an interesting company that's not a startup. Like you find those like every VC, but you also find, again, like you find Mendy, who's a black lawyer out of Texas, and she scores well. And so it's a little bit more, it's harder to explain because it's not like, oh, here's the one profile or here are the things that add points. It's really the combination of those factors
Yeah.
that lead you down that path.
Yeah, that makes sense.
Yeah, and also again, it's not only your education background. So if you drop out, that's fine. It's also your personality, and
Well, that will
turns out,
screw me right there. Come on, let's be
no,
real.
not sure, Arthur, because it was yesterday. We organized a webinar with some of our investors, so Foundation Capital, and Dave Yarnold was there. He was the CEO of ServiceMax, an investor in 212, and he's mentoring all our CEOs. And he said something that is very true. He said there is a pattern in all 212 Angels founders in the portfolio. There's a pattern. The pattern is they all have three characteristics. Number one, they are all our founders. So thanks to the algo, they are resilient. And resilience is and you know that because you invest in founders every day. Founders have to be resilient.
It's
otherwise
a good skill set, let me tell you.
it's fundamental. So that's, and honestly, we don't know why, but that's the outcome. One of the outcomes of the algo. You have to be resilient, then you score higher. Second thing, that's what Dave said yesterday. All our founders are coachable. So that's also very interesting, strength for a founder to be. You have, internal compass. You have your own opinions, but you are coachable. And the third thing, which is linked to the second one, is infinite learner. All our founders, again, founded by a machine, they all want to learn all the time and everything, which is, when you build a company, we strongly believe that's super, super important. So, to your point, you could be a dropout, but if you're resilient, infinite learner, and coachable, we may invest in you.
Yeah, super cool. Look, I couldn't agree more about those three things. In fact, this is not my show, it's your show, but I will tell you that what I've learned in life and in business is it's a series of adjustments. And if you're not resilient and coachable and you want to learn, you can't fit into that series of adjustments because you get stuck on stuff and you're done, right?
Yeah.
So it totally makes so much sense.
Yeah, and as investors, what we have learned is that if you use machines to invest, you'll probably perform better. That's why we're doing this. And when you talk to a lot of institutional investors, most of them are like, oh, do you think I could be replaced by a machine? So that's why usually most investors are so reluctant to use technology, because they usually, sometimes they're right, sometimes they're wrong, but most of them believe that, only them can pick great funders, and it's unacceptable to be, threatened by a machine.
Yeah.
We strongly believe that humans will remain in the loop, as Ben and I are in the loop of our process, right? But being augmented by a machine will result in the best VC performance ever, for sure. That's our belief.
Excuse me, it just sounds like a net plus to me. You can still look somebody in the eye after they
100%.
flip all your switches and say, I don't like the cut of his jib, right?
Yep.
Yeah.
It happens.
Yeah, totally. We do need to run. This has been super helpful for all you people that missed it. Too bad. We will post it, and as I mentioned, in about a week or so, we'll send out the date. Excuse me. We'll get to dig a little deeper and talk about the investment and the fund and how to get involved. And the fund's open for a while now still, right? You're gonna try to close out by December?
Oh, March. We have time.
March.
We have time, and you and I, we are all in a relationship business, which takes time. So we will take all the time that we need.
Yeah. Yeah, you're absolutely right about that. So super, super interesting, guys. Thanks so much for sharing all
It was a
that.
pleasure. Thank you so much, Arthur.
Yeah, you're very welcome. Ben?
Thanks, Arthur.
So to everybody here, thank you so much for being with us today. And as I always say, that thank you for sharing with us the only thing you can't make more of, and that's your time. Till next time.
Yes.
Thanks, guys. Take care.
Bye.
Bye.